What's amazing about real estate is there's so many ways that you can engage in that type of activity. Everything from buying land, developing it and building and producing a product to buying existing product. That product can be everywhere from residential type focus to commercial, office, retail. There's just so much out there that's available.
Welcome to the Idaho Real Estate Investor Show, where we bring strategies and knowledge that will help you succeed in Idaho's ever-changing real estate market. I'm Jonna Weber. I'm an Idaho investor, realtor, and entrepreneur. I've been successfully investing for over 2 decades and helping countless others do the same. We'll bring you real stories from successful investors, expert advice, and insights to help you build generational wealth through the power of real estate. Whether you're just getting started or well on your way, let's jump in. Hey, welcome back to the Idaho Real Estate Investor Show. We are so happy to have you back. I am thrilled to share our special guest today. I've got Rich Jarvis with me, and Rich is the president of Epic Capital Funds. He brings 26 years of management experience and 15 years in finance as a lender, insurance broker, real estate fund manager. And since 2023, he's helped capitalize over $450 million of real estate developments across the Intermountain West through his partnerships, and we'll talk a little bit more about that. Rich began his real estate journey back in 2003 with one rental property, and he's since built expertise in sourcing all kinds of underwriting investments, leveraging his entrepreneurial spirit and deep financial knowledge. And let me tell you, you are here to soak up and learn today. Rich, thank you so much for being here today.
It's great to be here, Jonna. Thank you.
It's awesome. Why don't you tell our listeners a little bit about what you're doing today? You're president of Epic Capital Funds, but what is Epic?
So Epic Capital Funds, our mission and everything that we do is to help our clients live and achieve their freedom of purpose. And whatever that means to them, we have every year, we'll do Epic alignment meetings where we learn from them what their goals are, what they're trying to accomplish. And if we can free up their time and help their money work for them by establishing and growing passive income and wealth creation through both real estate investing on the debt and equity side and private equity on acquiring businesses, then that's all of our decisions are based on helping us deliver what they need to achieve their freedom of purpose.
Okay. So they're being who's your typical client?
Our typical clients range from, so we have different segments. So clients meaning our core teams or partners, if you will. Some in the industry will call them sponsors of deals. And that includes the builders, the developers, our stacks. Our niche is to identify those core teams that execute phenomenally well throughout multiple market cycles. We form partnerships around them and then go deep into their pipelines. And that's one client, I would say. Another is investment advisors, wealth advisors, registered investment advisors, the RIAs. They would be another segment of our clients that we want to provide alternative sources of investments or opportunities to them so that they can better take care of their clients. And then ultimately, our partners, or part of the family, we call it, it's the investor. Yeah. And it's those who place their trust in us. We actually ask people, don't trust us, let us earn that trust. And by what we do and how we react to problems. And that's what we think builds that trust. But ultimately, those segments are the ones that we work with.
Okay. I love what you said about the second segment because that's really something that I want to touch on. A lot of folks that are coming to us at the Boise Real Estate Investor Network and certainly listeners of the show are very highly skilled professionals in their whatever sector, whether they're a physician or an attorney or CEO of a company. They have this idea of investing in real estate in some form. We talk to them all the time. And sometimes they'll come to us freshly off of a home flipping seminar or something because they think that's the way that they need to invest in real estate. So let's talk for a minute to the folks that want to get started in real estate, don't have a lot of time, maybe have some financial resources. What are some options to help break it down, layman's terms, on how they can understand how they can invest in something besides a house flip?
Yeah, absolutely. First off, what's amazing about real estate is there's so many ways that you can engage in that type of activity. Everything from buying land to developing it and building and producing a product to buying existing product. And that product can be everywhere from residential type focus to commercial, office, retail. There's just so much out there that's available. So for those that are interested in doing it, my advice would be it's okay not to do something alone. You don't have to do everything alone. And I think the biggest risks in real estate happen because people try to do it themselves and they try to go through everything. And there's tuition that will have to be paid, whether they learn it themselves or they learn it from others that have been through that. My advice is to align with those groups that have been doing that type of work for decades. And that's what I would recommend for those.
I love that. And I want to plug too, if you're out there and you're experienced and you think, oh, because you're not president of Epic Capital Funds or you don't have this huge like name on your business card, but you've been investing, we want you involved too, because
Absolutely.
you have something to share and something that you've gone through that others that come after you can learn from. So I think there's such wonderful synergy that comes from investors of all types coming together and learning from their experience.
That's one of the things I've really enjoyed about Boise Green is that environment where you can meet so many different people with like minds, and everyone's just been so gracious and willing to share. It's been a great experience that I've had so far. So thank you for putting that together.
Thank you for being part of it and help shaping the future of it, what we're becoming together. It's huge, and I sincerely mean that. And the contributions with folks like you are what make it possible and what makes a difference. No one wants to hear me talk about, I know one kind of investing, really a few, but in different sectors, but I'm buy and hold. That's been me, brick and mortar. I don't have the experience and the breadth of knowledge in the syndication world, for example. And so there's beauty in all of us coming together.
That's interesting because looking at real estate, I've always enjoyed real estate. My dad owned properties growing up. We participated as kids in those projects. So I've always had a love for real estate. But I've also, as growing up, I had a fear of doing things I didn't understand or know. And so I would do the things I knew really well or could learn and put the time behind it. But the things that were unknown, I kind of stayed away from, whether it was different segments of real estate or it was that fear of the unknown really that kept me from acting. And so when, going back to why we started Epic Capital, I realized throughout my career that good business or entrepreneur, when everyone talks about being an entrepreneur, you have this concept of you have to be an entrepreneur by yourself. A solopreneur, you have those things going out, and this idea that you're your own boss and you can do your own thing, whether you make it or not, it's completely up to you. All that's true. A really good business is not solo. That doesn't make sense. You have your clients, your vendor. It's about collaboration and how to add value and do things the right way for the right reasons and build that trust. It's who are you going to work with? And I love the book, Who Not How.
Oh my gosh.
Fantastic.
Yes. Rich, we got to get this book list and club out to everybody because that's classic now already.
But I think that concept is very important, specifically in real estate. For me, making the decision that actually it was more of a realization or an epiphany that I didn't have to be good at everything in real estate in order to succeed in real estate. But what I had to do is align and create teams and bring those pieces that I was weak in and to make strong. And because of that, just in the last couple of years, it's been a pretty tight financial market. Transactions have slowed, not a lot of capital markets being available. And as of today, from that partnership, for example, that we created in 2023, we've actually capitalized about $500 million in residential communities. It's not because of me. It's not because of one person, but it's because of the collective group and what we were able to do together. Even in this market, we were able to succeed. And I don't think individual pieces, we would have been able to do it. So I'm convinced that it's about the teams that you put together to make things work and mitigate those risks.
I love that. So if you are an outside investor looking at working with a team, what does really Epic is an example, but whatever vehicle or group that an investor is investigating to align with and to create partnerships with, it sounds to me like it's more than just a transaction. You're building a relationship with that investor, right? And that
Yeah.
investor needs to be bought in. There needs to be a mutual relationship there.
Yeah. I've deliberately chosen not to look at any one transaction.
Okay.
To me, the transaction level. So there are strategies where you can go wide and get as many different transactions on the table as possible. And that's a strategy. Our strategy is different in the fact that we want to first work with the people and then go deep in their pipelines to have a lot of transactions with that group.
I see.
Then it's not a transaction level conversation every single, because if you go wide, you're putting yourself out there for me, it's a risk that I'm not willing to take. Because I don't know what's going to happen when challenges will come, how those groups are going to handle it. And so by identifying those groups, we know how they handle challenges and problems, and they do it with the investor's best interest in mind. Those are the ones I want to align with. We've spent the time vetting out a lot of groups because we want to bring the investors in with those sponsors and create that synergy that we can do multiple projects and get away from the one transaction feel.
Okay. We're going to talk in layman speak for a minute because I know some people, again, this audience that is interested in passively investing. You mentioned sponsor. A lot of people don't know what that is.
Mhm.
And probably the buzzword, we hear the word syndication
Mhm.
all the time. Are you really kind of talking about a syndication, Rich? And what is a syndication?
So a syndication or a fund, those can be synonymous.
Okay.
Essentially, if you have one person that can fund an entire transaction, whether it's to buy a home or apartment complex or whatever it might be, that's more of just a transaction. A syndication comes in when instead of focusing your work on a house flip, one home, you're putting together a community of 400. Typically in that scenario, one person isn't going to fund the entire project. And there's some that do that are out there, but for us, that's not the typical client that we work with. It's providing opportunities for people to participate in projects that otherwise they would never have a chance to be part of. And that's what a syndication is. It's bringing multiple people together to fund a project that has better efficiency, higher probability of success than one transaction that may or may not work.
Okay, that is so clear. Thank you so much for sharing that because I think there's a lot of confusion out there on what's what and what they can do. I'm just thinking, okay, we're going to take Joe as an example. Joe's a higher income earner. He's earning $500,000 a year at his corporate great gig, and he's got some expendable income. Is this something that he could look at, or Joanne, she could look at to funnel some of their funds? And how do they start the process of finding out where they should go or who they should invest with? What's their vetting process?
Maybe I could just share what it's like of who we work with,
Okay.
what experience that they go through. So typically when we meet investors for the first time, we're more interested in learning what is important to them because we may not be a good fit for them. And so we've referred investors to other wealth advisors that we think would align really well. But I think the important thing is to understand what the investor is trying to accomplish over time. And in our world, we're not wealth advisors. I can't give investment advice in that sense. But we want to understand what the goals are. Typically, we'll divide up someone's portfolio into different categories. You have your savings for an emergency fund and savings, something that's liquid that you can get to if needed. You have, let's say, 30% of the portfolio into investable assets that are liquid that you can get to. And then 60 to 70% of the other portfolio is something that's generating income, that's creating wealth that may not quite be liquid, but over time is far more stable, and it produces better returns, but it's just simply not liquid. So it's a balancing act between all three of those. And we never really want to put someone in a position where they're taking their liquid assets and putting them in something that's not liquid. You can't get it within a certain period of time. Because real estate, generally speaking, especially in developments, you don't have access to that money right away.
Right.
it's a process to get it out, whether it's a refinance, a sale, or other restructuring, meaning you recapitalize and bring other investors in and buy out. But the first understanding that process, and we need to know who the investor is, and then assuming that there's a match as far as the income or the wealth creation or what their goals are. And if we understand that they are accredited investors, and there's multiple ways to qualify to be a accredited investor. Some of it has to do with income. One of it's net worth. For example, $1 million net worth outside of your home. Would someone, if you have $1 million, you'd be considered an accredited investor. You can even have a license, a securities license, and being accredited. So there's multiple ways to qualify. So once that's determined, then we can share the opportunities that we invested in. For some, an example of those that we've already funded, and we've got projects throughout the Intermountain West. And we only focus on those projects that we have boots on the ground, that we know the markets, that we're comfortable with the trends, and we have that understanding. So that way we can share direct knowledge with the investors of the reason why we're doing certain opportunities versus others. It's a little bit different on the private equity side when we acquire businesses, but that's a different model. And based on the market cycle we're in, some investors want income right away. So that's where the value add concept comes in, where you buy an apartment complex, it's fully stabilized, it's full. You think you can add value to it by improving the grounds or increasing the rent somehow, but it produces monthly income right from the beginning. Whereas a development loan could be 2 or 3 years before it produces any income at all. And so understanding the difference and the risks and the rewards for each is important.
I love that, the understanding the risks. I did a podcast, I think it's episode 8, that came out recently that I was talking about that same thing. I think as an investor, even on a very part-time or passive level, you've got to know yourself, and you got to really take a deep gut check on your risk tolerance and why you're even investing in the first place. And I love that you say you get to know the investors and get to know what their goals are, because I know personality types that if you tied up their money for 4 years, and they had no control over the outcome, really, so to speak, they wouldn't sleep at night. And then there's the ones that once they understand and have all the knowledge and so forth, they understand the liquidity of it or not and so forth, and they're comfortable going forward. But there's many different investor styles.
Yeah. So we align with investment advisors quite a bit in a joint effort so that they can look at their whole portfolio and understand on a wealth management side, and then the allocation that they recommend, then we can help provide those opportunities.
I love that. It's just like a vehicle that's available to there, and it's so personal. You assess your total portfolio and have different assets in it. So I am a big believer in not putting all of your eggs in one basket. So I think it's a great thing. And we've all learned from things like that, right? I know that you and I were both in real estate during the recession, and this talk about failing forward. There's things, but I was way too allocated in certain things at that time.
And it's interesting too, because when you understand the downturn, most of, not all, but a large majority of those that were hurt were because they felt like they were forced to sell and they lost money in that sale. Whereas how many of those investors would absolutely love to have owned that property at the full price that they had paid?
Probably 100%.
Absolutely.
Yep.
And it's this fear and greed. It's the fear and greed index. And we're quite contrarian in nature. When people are scared and pull out of the market, I love going in and developing and building, because when we're finished, everyone's ready to come back in and we have something for them to buy. And it's just, it works really well that way. We got that from Warren Buffett back in...
Yeah, that's the first thing that came to mind.
1984, I think it was the letter that he penned to his shareholders. And he talked about a disease that they don't have enough resources to predict. And the disease that he called it was fear and greed. And he says their approach was very simple. When others are greedy, they're fearful. They want to just sell it to them and get out, right? And then when others are fearful, because they get greedy, then they go in and they'll just buy everyone's projects at 30 cents on the dollar. And
Yeah.
so I think understanding that there will be market cycles, but it's the emotional decisions, thinking that if you don't sell now, you'll lose everything, and misunderstanding what real estate is and the utility and the longevity, that there's a reason banks will lend 70, 80, 90% on real estate. For the most part, it's because it's tangible asset that can weather
Right.
decades. The problem comes when you try to force a long-term investment into a short one and make it perform when things become uncertain.
You've mentioned market cycles more than once. If you had to guess, I know sometimes it's so much easier to look back and know, but any inclination of where we are in the market cycle right now?
My first response is wherever we are today, it's going to change. And I think the mistakes come when people try to say and make decisions based on something not changing. And their projections are all linear, when nothing is ever linear when you're dealing with money and real estate. Where we're at right now, I think it's interesting. There's still some uncertainty in the markets. People are moving towards, they want monthly income versus an upside, because that's something that they can see and count on right now. And that's going to change in a little while. It's going to shift, and people are going to be back to the greedy side, and they're wanting as much upside on these projects as they can possibly get. But I think right now we're in a market where people are still holding back. And so we've created a debt fund. We provide the monthly distributions.
I wanted to ask you about a debt fund. Will you explain to our listeners what a debt fund is?
Yeah, we use both equity and debt. So debt, something that's tied to, most common would be a first position deed of trust on a project or a property. That's probably the most secure way of doing things in the traditional sense. Then there's, on the operating agreement side, there's future revenues, and you can attach revenues of an entire portfolio of projects. And so you're not tied just to one, you're spreading that risk across a much larger group of projects. And either way, it's producing income. Debt funds can be specific to either one. The one I'm referring to was, we had fully capitalized projects that were going to produce revenue in the next 2 to 3 and even 4 years. And so that revenue became the collateral for that debt fund. And then we're able to use those proceeds to pursue costs on other projects and then bring that back into the collateral. So it was a continually evolving, so collateral kept increasing, if you will. And then for developers and the sponsors that have momentum, that are doing a lot of transactions, it's worth it to them to pay a little higher interest rate and have access to that capital to get projects across the finish line than to stall projects and not have that momentum built. That's why we use those kind of debt funds. But there's quite a few different strategies you can use.
So, and these are all vehicles that are potentially available for someone to invest in.
Absolutely,
right?
yeah.
So it's so interesting just to think outside the box. I know even in just creating this community of investors over the last couple of years, I have been exposed to so many types of investing that I wish, looking back, so much that I would have known about, because I just thought it was one way, and it was great. It worked for us, investing in properties, but wholly owned, traditional way, traditional mortgages, traditional headaches with water heaters leaking and all the things, and probably missed out on a lot of opportunities. And so I think it's really important for people, as they're analyzing all their investment vehicles and possibilities, that they take all these kind of passive opportunities into consideration as, like we talked about, part of their portfolio. So I love that you're unpacking that and teaching that. Hey friends, if you're busy like me, you're always on the lookout for trusted professionals that can help you with your business, home, and investment needs. Whether it's a trusted lender, real estate professional, or a vendor that might be able to come in and work on your home or your investment property, there's always a need out there, and we want you to have great resources at the ready. So Boise Reen has developed an exclusive vendor directory chock full of businesses that are ready to help our community. Head on over to boisereen.com, grab your free copy today, and don't forget, let them know that Boise Reen sent you. How did did this evolve? Like the Epic Capital Funds. You have such an eclectic background, Rich.
My first introduction to debt funds was in 2004.
Okay.
We managed and we lent money on real estate. So that's where my first exposure came in. From there, it's just evolved. And during the downturn, what we noticed is there were some debt funds that were incapable of holding properties. It just wasn't as part of their makeup. They literally couldn't do it because of their charter. And because of that, they were forced to sell at exactly the wrong time. Whereas if they could have moved over into an equity position and just held those properties, it would have cost some to hold them because of property taxes and those kind of things. But in the long run, those investors would have been infinitely better off having the flexibility to make decisions based on the market cycles that they're in. That was a huge part of shaping why we're doing what we're doing. Epic Capital started with the group. We put it together. I came in to help them manage their capital. We call it a capital stack. It's just finding the financing for it, whether it's bringing investors in or bank debt or other types of debt and financing that transaction. And so when I say capital stack, that's what I'm referring to, both the debt and equity piece.
Yeah. And you just made me think about, you mentioned you have an acronym that I think is so awesome. Can you tell us about that?
Succeed?
Succeed.
Yeah, sure. So Succeed stands for, it's how we look at all of our projects and what we go through to determine if we're going to go forward or not. And S is really how we're going to structure it. Structuring can be anything from one person wants to, like what you were doing on buying your home. You had one investor, you went in and you most likely either paid cash or brought in some debt to help cover.
We use W-2 income to get traditional
There
mortgages.
you go. Yeah. So that capital stack, if you will, was that mortgage that came on and the money you brought in as equity to buy that transaction. So you could structure it that way. Or let's say instead of one home, you wanted 300 and you wanted to buy an apartment complex, but you only had a little bit of cash to put into it. You're still going to go to a financial institution to get the debt, and then there's equity. And so what a fund is, or a syndication, is just you're pulling more assets to cover that equity requirement to acquire that project. And then you can use a better, instead of, it just becomes more efficient because then you're managing that many. And instead of one person providing an income, you have 300. Instead of you having to do everything, you can actually have a team that's very good at what they do, managing that and keeping those costs down. So the cost per unit is far less than what you would experience on a one-on-one basis. That's an example of structure. Another example of structure would be you're doing a development, you're buying land, and there needs to be different phases. And so how do you bring in the equity at the right time? And if you do it in phases, can you reduce the equity requirement and bring in different types of debt financing to make the project work? Or do you need to pay for it all cash now and then so it's just how you structure the deal.
Okay.
And who are the investors are going to be involved in understanding that. The next thing is underwriting to make sure that it pencils. I'd love to get some value add, is what people call it, transactions, but they're just very difficult to find right now. They're far overpriced for what you'd get. And it would still take quite a bit of capital to put into it to get people to even want to increase the rents that they're already so high.
Right.
Whereas right now, because of the teams we're in, we can build something cheaper than we can buy.
Right. And value add is like taking a property that, I'm just explaining for the audience, right? That maybe it's an apartment complex that needs a lot of, has a lot of deferred maintenance. You want to bring up to speed, get it up to that next kind of class of rental property. Is that what you're talking about with value add?
Yeah. So everything comes down to the net operating income, the NOI, right? And then what the cap rates are. For example, if you had 300 units and you can increase the NOI by 100 per unit per year, that's quite significant. Thinking on real quick, so I don't have to do it in my head. But if you had $100 increase times 300 units over a year, that's 360,000 direct NOI increase. But the value is, what value did you just create? It wasn't just 360,000. If you're at a 6% cap. That's a $6 million increase in value that you increased by doing that. That's what a value add is.
Gotcha. Okay, perfect.
For me, I think one of the best value adds that you can do that you have full control over is a ground up development.
Mm-hmm. And I know that you've been having, and others too. I've seen a lot of examples of that.
Correct.
This year.
And the value that you can add to, if you can capture the value of taking dirt and then getting it to a point where it's fully entitled, there's a lot of value increase there. And then getting it from being fully entitled and approved to built out so you can actually build structures, there's a lot of value there.
That's called going vertical, right?
And that's even before.
Oh,
That's
before.
getting it ready to go vertical.
Okay.
And then when you go vertical, there's a value there. So when we partner with groups, it's to capture value from the entire life cycle of a real estate project. And so when you're all said and done, we can deliver something of a much better value than what we can just go out and buy and try to improve, at least right now in the cycle. That will change.
Yeah.
But that's an example. So
Okay.
underwriting.
Right.
The next thing is the core team. So it's who we're working with in the acronym Succeed. The other C is the capital stack. So it's who are we bringing in to fund the deal, whether it's debt and equity or what types of investors and that kind of thing. And then E is what is our exit strategy? What is our plan? Was this a long-term 10-year plus hold, or is it a 2 to 3 year turnaround? And so understanding what those are, and then having a backup. When that doesn't work, what's your next plan, right? And then the due diligence, just diving into making sure that you have everything in line, and what you're getting is what's being represented is what is real. How many times have you been aware of sellers coming together, you're buying property, it's represented this way, and they dive in deep and realize, no, it's completely different than what they thought. So that due diligence is so important.
Right.
That's the acronym Succeed.
Okay. That's super helpful. Thank you.
You're welcome.
Might be able to put that in the show notes too. And just giving people those tangible tips, I think, is so important. And I wanted to dive in on a couple of things just on a personal note. I noticed when I was reading some information, I think it was on your bio, about Ironman races. I got to ask you.
Okay.
My jaw dropped. I had no idea. I've known you for a year now. You participate in anything like that.
Yeah.
Why? That's crazy town, but it's amazing.
I've done 5 they were half. So just to be clear, it wasn't the full, but the half. So that's the 1.2 mile swim, 56-mile bike, and a 13-mile run. So that's the half.
That's it.
Done quite a few of the sprints in the Olympic distance, but I've done 5 halves. And it was at a time when, so in 2010, when everything was going crazy, I was at the bottom of the bottom, right? It wasn't diagnosed depression, but looking back, I was completely depressed. It was just a hard time to go through. My kids were watching all of our assets being sold just to cover everything. So everything was just going, and it was just a hard time. Doing an activity like the triathlons, I think, saved my life.
Wow.
It was a way that I could get out and just focus. And when you do exercise, it's going to help anyway. But that focus of just doing something because I needed to work on myself, it literally saved my life. But when you start getting competitive, you're spending 25 hours a week minimum on a half. You have to probably spend 35 to 40 hours a week on a full Ironman to be competitive. But
that's time that's hard to find, especially as a busy father. And I know you're so involved in so many things.
All our kids did triathlons. So we all went and we swam together. We went. So that's how we started.
I love that.
It was pretty cool.
I should have. Kids, you're listening, you're like, Mom, you didn't do that with us.
Kids are natural triathletes. They all love running around. They ride their bikes and they love, they're just natural triathletes anyway. So it was one of those things where we could all do together. So that's why we did it together.
Oh my gosh, I had no idea. That is so cool. And you're so right. I think with the exercise piece of it, we all know that. We all know that it's a stress reliever. But I remember being motivated to exercise way back when. Who was it? One of our presidents, I think it was probably George Bush, the second one, was running every day. And I remember, like, if he has time to run every day and he's the president of the United States, I have no excuse.
I think if someone had asked him, he goes, how can you afford to take time to run every day? And he's, I'm so busy, I can't afford not to.
Right.
So it's just one of those. And I think if I could leave one thing with the audience, it's just the concept of what's the mindset in the morning, owning your morning. Part of our company values is we have a 5AC, is what we call it, 5 a.m. club mindset. And what I mean by that is looking back, one turning point in my life, looking at a transition in my career, didn't know what was going on. And we'd been through all of these ups and downs, multiple. And so things were uncertain. And I remember I brought my wife out to lunch and just to let her know that my current endpoint was changing and we're going to have to go a different direction. And she told me, it's interesting, it changed my life. She says, and I wanted pity. I was like, I wanted someone to say, oh, I'm so sorry. Someone to mourn with me, right? That's not what happened. She goes, sounds like you need to start a gratitude journal.
Oh.
And I'm like, okay. So
Debbie Downer.
But she was totally right. And it was amazing what happened because when you have anxiety and you don't know, or you're faced with all these decisions and you have that decision fatigue and you're so uncertain, just stop and start a gratitude journal. What are you grateful for? And you will experience that you cannot experience gratitude the same time as anxiety and fear. It just doesn't exist together. And that was the impetus that started the journey towards Epic Capital. And
that's powerful.
The other concept is the morning. You know, some books, the 5 a.m. Club is really good. They talk about your mindset, your health set, your soul set. We have your physical set, your heart set, so emotional. And then another book, The Way of the Seal. It's Navy SEALs by Mark Divine. He has his box breathing exercise. And then he calls it his mind gym, a place where he goes in his mind and he transacts. But a big part of that is the breathing. It's the gratitude piece, and then focusing on what's really important. And for us, I think for investors that are looking to try to figure out how to achieve their purpose and how to leverage what they have, there's so many decisions out there. I would just say stop for a minute, just breathe and show gratitude, and then move in the direction that you're wanting to go.
I love that. And we slow down. I've been really working on that myself this year. And you slow down and you sit from within. I know we both believe in God and higher power, and those little gurglings, like I call them, like these little nudges and gurglings where you're led in these directions on where you're supposed to go. And you may not understand it all the time, but if you don't slow down, if you don't take time for prayer and meditation and being still with yourself, you're never going to feel it, because this culture will suck you dry with everything coming at you 24/7. Yeah. So I love that you brought that up. Thank you.
We call it owning the morning.
Right.
And if you own your morning, you'll own your day. And if whatever that means to you, for us, it means going through that, and that includes exercise, but breathing, showing gratitude, and then just focusing on those few things that you want to accomplish. And their example of this would be Tony Robbins. He has a primer that he does in a day. And I think that's a free download that people can get. But that's been a huge influence as well.
Do you cold plunge?
I have, especially when I was training. I haven't done cold plunge recently. Every time I have done it, it's, I guess, refreshing is on that one. But you always feel so much better.
I haven't done it. I just watch y'all do it. And I know Tony Robbins does that cold thing every day.
Your very first time is by far the worst. It gets much easier after that, just to let you know.
Right. That's great. We could talk forever on books, Rich, but the power of habit and all of those things, just incorporating those things into your life is huge. So speaking of life, I always like to wrap up our podcast with asking about you and your future. Like, what are a couple of fun things that you see in your future of the next 3 to 5 years?
So that has to do with family. I was asked the question in my business, how many quarterly meetings do we have, weekly meetings, and we have these goals, and we have in EOS, we have rocks, right?
Yep.
And they asked, so what are you doing for your family? Are you having those same things in your family? And the answer was a part answer. There's some things we were doing and there's some things we weren't. So we've actually instituted a family legacy. We're doing EOS with our family, essentially, where we have our core values that we focus on. And when you look at what you want to pass on from generation to generation, wealth is only one piece. And it's actually the most insignificant piece that you can pass on. Character, who they are, what they want to accomplish in life, their purpose, how are they giving back? We call those different types of capital. You have your social capital, your emotional, your spiritual capital, all of those things. And how does that fit in and how are we moving that on? So over the next 3 to 5 years, that's what we're doing in our family. Last year, we did a humanitarian project in Costa Rica, help build a school. This year, we're going to most likely do some trail restoration throughout some of the forests. And we'll do that as a family. And part of that is you do that and then you reevaluate what your goals are. And then everything we do just comes back to recognizing you did that and that matches your core value. Congratulations. And what we can do to support each other to achieve something epic, really is what it comes down to.
That's a great fitting way to end the podcast.
There we go.
Let's do something epic together. And I think you're an epic business professional. And I'm just grateful to have you in my life and
Likewise.
as part of our community. And we just keep growing and reaching together. And I know there'll be more failing forward and all of that sort of thing. But if we're in it together and have that community, we're going to go so much further than individually. So this has been impactful. I know the audience has taken away a lot, especially those that are looking at how to get involved in this investing game. And so I just appreciate that.
And I'm happy to answer any question. If anyone has just questions or they're looking at,
And I was going to ask, what's the best way to get a hold of you?
Oh, yeah, just email or phone. You can provide that. They can text me.
I'll be in the show notes.
But there's a large number of people that have come in that really wasn't the right fit for what we were doing, but we were able to help them go in the direction that they needed to go and connect with those that needed to be connected. So our mission is what it is, where our goal is to help, and everything we do is to help people achieve their freedom of purpose, whatever that might be.
I love it. Guys, thanks again for joining the Idaho Real Estate Investor Show. It means so much if you hop on to your podcast listening device or especially Apple iTunes, give us a quick 5-star rating and review. Share the episode. I know that you've gotten value today, and we can't wait to see you on the next episode. Have a fantastic day. Well, that's a wrap for today. Thanks for joining me here at the Idaho Real Estate Investor Show. I hope you're leaving with new insights and inspiration to help you truly grow wealth through real estate. If you enjoyed the show, do me a favor. Please subscribe, leave a review, and share it with those that can benefit from it. Go and grow, and I'll catch you on the next episode.